America's housing market collapse 2025 is unfolding right now. Not next year, not someday, but today. Beneath the headlines of record home prices hides a brutal truth. A nation drowning in debt, vacant homes, and shattered dreams. From foreclosures in Florida to empty towers in California, the illusion of wealth is disintegrating in real time. Builders are panicking, investors are retreating, and families are collapsing under impossible mortgage debt. This isn't a slowdown. It's a slow-motion implosion. What we're seeing isn't a correction. It's the death of the American dream happening before our eyes. In 2025, America's housing market has become a stage of illusions. A grand performance where record prices mask a nation nearing financial exhaustion. On paper, home values look strong. Zillow lists the median home price around $420,000, nearly 45% higher than pre-pandemic levels. But behind that glittering figure lies a grim reality. The average American family can't afford the American dream anymore. It's not slipping away. It's vanishing. Homeownership was once the symbol of stability. In 1980, the typical home cost 3 times the median household income. Today, it costs nearly 8. That means middle-class workers, teachers, nurses, firefighters are priced out entirely. Mortgage rates above 7% have turned a $1,500 payment into a $3,200 monthly strain. The average household must now earn $120,000 a year just to buy a modest starter home, yet median income hovers near $75,000. The math simply doesn't work. And while headlines cheer record home equity, the streets tell another story. For sale signs linger for months, price cuts are everywhere, and builders are offering free upgrades, rate buy-downs, even backyard pools to lure buyers. Sellers cling to fantasy 2022 valuations, unwilling to face the real market, one driven by wages and savings, that's collapsing in slow motion. Meanwhile, younger Americans have checked out completely. Nearly 80% of Gen Z and millennials say homeownership is no longer possible. Rents keep rising, credit card debt has topped $1.3 trillion, and savings have fallen to pre-pandemic lows. The dream of a white picket fence is being replaced by renting forever. This isn't a boom. It's a mirage built on inflated appraisals, corporate landlords, and financial strain. And as the facade crumbles, one truth remains. America's housing market isn't thriving, it's suffocating. The illusion of record prices is the final act before the collapse. That illusion can't last forever before the cracks spread wide. And those cracks look hauntingly familiar. To anyone who lived through 2008, the mood feels like déjà vu. The same calm before the storm, the same confidence built on sand. Back then, America's downfall started quietly, with homeowners convinced prices could never fall. Sound familiar? In 2008, it was subprime lending, zero down payments, and liar loans. In 2025, it's reckless valuation. Homes listed at fantasy prices as demand disappears and sellers chase fewer buyers with desperate incentives. But there's a darker parallel in America's housing market collapse 2025. In 2008, the banks were over-leveraged. Today, it's the people. Household debt has exploded to $17.6 trillion. Credit card balances alone exceed $1.3 trillion, and delinquency rates are quietly climbing. Millions of families are stretched thinner than ever, clinging to homes they can barely afford, praying the market rebounds like it did before the last real estate crash. And while today's homeowners may not be underwater yet, the warning lights are flashing bright red. Adjustable rate mortgages are resetting, savings are drained, and job growth is losing steam. Even corporate landlords, the institutional giants once seen as stable, are quietly offloading inventory. Blackstone, Invitation Homes, and smaller hedge funds are unloading properties across the Sun Belt, fearing rising insurance costs and weakening rents will crush their margins. It's the modern replay of the 2008 sell-off, but this time the exits are crowded. In both collapses, confidence disappeared first. Once homeowners stop believing prices will rise, the illusion collapses from within. Fear spreads faster than any rate hike ever could. That's where America stands now, on the same cliff's edge, but with far more weight pressing down. The echoes of 2008 are louder, and the data makes them impossible to ignore. What started as whispers of doubt has become a flood of listings nationwide. Neighborhoods once covered with sold signs now glitter with for sale banners that never come down. In cities like Phoenix, Tampa, Austin, and Las Vegas, housing inventory has jumped more than 70% since last year. For the first time in nearly a decade, homes aren't flying off the market, they're stacking up. It's not a normal increase. What's happening is a full-scale wave of fear and financial strain. Many homeowners who bought at peak prices are scrambling to cash out before the downturn accelerates. Meanwhile, builders who race to meet pandemic demand are left holding unsold developments. Giants like Lennar and D.R. Horton have thousands of new units waiting for buyers who no longer exist. The months of supply, once a healthy 3, has doubled or tripled in several regions, marking the shift from a seller's market to a buyer's standstill. But a deeper danger lurks beneath the surface. These aren't just listings, they're potential defaults waiting to happen. Rising property taxes, surging insurance premiums, and mounting maintenance costs make keeping these homes painful. Investors who scooped up dozens of properties to flip or rent are now walking away, realizing their math doesn't work. In parts of Florida and Texas, investors account for nearly 1 in 4 listings, flooding markets and driving prices lower at record speed. For real estate agents, it feels like the music suddenly stopped. Open houses are empty, offers are scarce, and price cuts are the new normal. The national average home now takes 55 days to sell, a stunning reversal from the 15-day frenzy of 2021. And behind every unsold property stands a homeowner growing desperate. This is how collapses begin, not with overnight panic, but with silence creeping street by street. The same fear that haunted 2008 is back. Only now it's amplified by heavier debt, higher interest rates, and an economy stretched to its breaking point. The next phase won't be about listings, it'll be about survival. For builders, sellers, and buyers alike, as inventory surges across America, one question looms large. Why aren't buyers stepping in during America's housing market crash 2025? The answer isn't just fear, it's math. The same forces that filled the market with unsold homes have now locked millions out completely. Mortgage rates, once the heartbeat of real estate, have turned into a weapon. What was once the gateway to the American dream has become a wall few can climb. When rates broke past 7.5%, affordability collapsed overnight. A $400,000 home that cost $1,800 a month just 3 years ago now demands nearly $3,600 in monthly payments. The American dream didn't just get expensive, it doubled in price. Even with moderate wage growth, income simply can't keep up. Each percentage point increase in mortgage rates erases millions of qualified buyers, shrinking the pool until only the wealthy and corporate investors remain. For middle-class families, the result is devastating. Many who pre-qualified in 2021 found themselves priced out by 2023, watching their buying power plunge by 35 to 40% while home prices barely moved. Lenders report collapsing applications, and banks that once handed out pre-approvals freely are now turning away clients with once golden credit scores. But the true shock runs deeper, in psychology. Americans no longer trust the housing market to protect their future. A generation raised to believe real estate always rises now sees headlines warning of overvalued metros and looming corrections. Confidence, once the market's invisible engine, is evaporating. The higher rates climb, the less anyone believes home ownership is worth the sacrifice. Meanwhile, those who bought at the top feel trapped. Refinancing is impossible. Equity growth has stalled, and homeowners are suffocating under payments that consume half their income. For many, selling isn't an option, it's surrender. This is the quiet breaking point, where rising costs meet fading faith. And as mortgages choke the market, another wave builds beneath the surface. Builders and investors stare at homes no one can afford. As mortgage rates strangle demand, the next tremor shakes the foundation: the builders. The same companies that fueled America's construction boom now face ghost subdivisions and half-finished neighborhoods. What was once a golden era has become a slow-motion crisis. Across the country, new homes sit unsold, while developers learn the lesson Wall Street ignored in 2008. Expansion without demand always collapses. In 2021 and 2022, builders raced to meet insatiable demand, buying land, securing permits, building nonstop. But once rates climbed past 7%, buyers vanished, leaving hundreds of thousands of vacant or nearly completed homes. In states like Florida, Texas, Arizona, and Nevada, construction pipelines have swollen so large that some areas now have twice as many homes as active buyers. To survive, builders are cutting deeper than ever. Companies like Lennar, Pult, and D.R. Horton are offering steep discounts, slashing prices by $40,000 to $70,000, covering closing costs, or buying down rates just to move inventory. Some projects are paused mid-development, others quietly abandoned. The same neighborhoods that symbolized prosperity 2 years ago now stand half-lit at night, their empty driveways reflecting a nation in denial. This panic in America's housing market crash 2025 isn't just about numbers, it's psychological. Builders measure markets by momentum, and once that momentum breaks, confidence disappears. Construction jobs are vanishing, suppliers are cutting hours, and small contractors who thrived during the boom are folding. The ripple is spreading far beyond the job site. From lumber mills to hardware stores, everyone down the chain feels the slowdown. Behind closed doors, many developers already know the truth. They built for an economy that no longer exists. The dream homes meant for growing families now stand silent, waiting for buyers who can't qualify and investors who no longer believe. What began as a mortgage crisis has morphed into a supply shock, a surplus with no demand. That imbalance, the widening gap between what's built and what's wanted, is pushing America toward its next breaking point. A market oversaturated, overleveraged, and one step away from collapse. And as builders struggle to unload their unsold homes, another corner of the housing market is cracking: the short-term rental empire. For years, Airbnb hosts were the stars of the post-pandemic real estate boom, turning suburban homes into personal cash machines. But as mortgage rates soared and tourism softened, that easy money evaporated overnight. What was once a gold rush has become a desperate sell-off. The story begins with saturation. In cities like Orlando, Phoenix, Austin, and Las Vegas, Airbnb listings have surged over 40% since 2022, flooding the market with vacant properties fighting for the same dwindling guests. Hosts who once earned $6,000 a month are now lucky to clear half that, and many are losing money. With travel demand weakening and nightly rates collapsing by 25 to 30%, thousands of short-term rentals are being converted back into long-term leases or quietly listed for sale. But the real damage runs deeper than lost bookings. Many of these properties were purchased at inflated prices, financed with adjustable loans, and depended on near-full occupancy just to break even. As expenses climbed, from insurance and cleaning to property taxes, profit margins vanished. Entire neighborhoods that once buzzed with vacationers now sit eerily silent, their driveways empty, their pools collecting leaves. Investors once praised as visionary entrepreneurs are now among the market's biggest sellers. Some are offloading multiple properties at once, flooding platforms like Zillow and Redfin with listings priced tens of thousands below their 2021 peaks. The oversupply from builders has collided head-on with this investor exodus, forming the perfect storm. Too many homes, too little demand, and confidence evaporating across the board. Communities are feeling the strain too. Cities from Denver to Nashville are tightening regulations, adding taxes and restricting permits to stabilize neighborhoods overwhelmed by investor-owned rentals. But those fixes are arriving too late. The speculative bubble that built the Airbnb economy is bursting in slow motion, eroding wealth, confidence, and the illusion that real estate always goes up. From luxury condos to quiet suburbs, the short-term rental collapse isn't an isolated event. It's the echo of everything that came before. Too much supply, too little affordability, and too much blind faith in a market that never truly recovered. as short-term rentals crumble under the weight of oversupply and fading demand. Another giant in America's housing market crash 2025 begins to fall: commercial real estate. What started in suburban neighborhoods has now crept into the glass towers of America's cities. The same forces draining value from homes, high interest rates, falling demand, and reckless overconfidence are now hollowing out downtown skylines. Once symbols of prosperity, office towers from San Francisco to Chicago stand as vertical monuments of denial. Remote work, once dismissed as temporary, has become permanent. Millions of square feet of office space sit empty, with vacancy rates in some cities surpassing 25%, the highest in modern history. Corporate tenants are downsizing or leaving entirely, while smaller businesses, squeezed by borrowing costs, are walking away from leases they can no longer justify. With every vacancy, property values plunge, and with them, the collateral banks once relied on to remain solvent. This is where the danger multiplies. Many of these buildings were financed with short-term loans now due for refinancing at double or triple previous rates. A property that once generated steady profit is suddenly bleeding cash each month. Banks already struggling with weak mortgage demand now face a rising tide of commercial loan defaults. Analysts warn that nearly $1.5 trillion in commercial real estate debt will require refinancing by 2026. A ticking bomb in a market already starved of liquidity. The fallout ripples outward. Cities depend on commercial property taxes to fund schools, police, and transit systems. As values collapse, tax revenues dry up, leaving local governments facing massive deficits. Downtown districts that once thrived now resemble ghost cities. Food courts empty, hotels struggling, retail stores shuttered one by one. The same pattern repeats: overbuilding, overconfidence, and a brutal correction. The collapse of the residential sector has bled into the commercial, merging two crises into one accelerating implosion. From empty Airbnbs to vacant high-rises, America's real estate is unraveling on every front. And what's coming next strikes even closer to home. The commercial towers may be falling first, but the shock is spreading to ordinary families. As financial strain deepens, a silent crisis is brewing in America's suburbs, one foreclosure notice at a time. What began with high mortgage rates and fading demand is turning into something more personal: the loss of homes. Behind polished housing statistics, the same story repeats: too much debt, too little income, and no escape. When rates soared, many homeowners believed the pain was temporary. They drained savings, maxed credit cards, and tapped home equity to stay afloat. But those buffers are gone. Across the nation, delinquency rates are climbing, and foreclosure filings have surged more than 30% from last year. It's not reckless lending. It's unaffordable living that's forcing people out. Adjustable rate mortgages are resetting higher, insurance premiums have doubled in hurricane zones, and property taxes continue to soar. Even once secure homeowners now find themselves cornered, trapped by costs that refuse to fall. Many are trying to sell before it's too late. But in a market flooded with listings, buyers now hold all the power. Every price cut pushes another homeowner underwater, accelerating the chain reaction. Behind the numbers lies something deeper: an emotional collapse. Families who thought they were secure are packing boxes, leaving behind homes that once symbolized years of sacrifice. Neighborhoods once alive with construction are now haunted by "for sale" and bank-owned signs. Local governments, already losing revenue from collapsing commercial real estate, now face another blow as foreclosures spread and community stability erodes. Banks, scarred by the 2008 crash, are managing the fallout quietly. But the pattern is unmistakable: a rising tide of missed payments spreading from middle-class suburbs to investor-heavy metros. Each foreclosure adds to the swelling inventory, pushing prices lower, trapping more owners, and igniting the next wave. The housing market that once looked unstoppable is now feeding on itself. What began as a mortgage rate problem has turned into a full-blown confidence crisis. As homes slip through people's fingers, America's rental markets, once seen as a safe refuge, are cracking under the same pressure. The foreclosure signs tell one story, But the silence that follows tells another. The American dream isn't vanishing with a bang. It's fading with exhaustion. From glittering cities to quiet towns, the promise of home ownership, that golden symbol of success and security, is slipping away. The housing market crash of 2025 hasn't just destroyed balance sheets. It's broken something deeper in the national psyche. For generations, owning a home meant victory, proof that hard work led to stability. But today, that dream feels like a mirage. Families who did everything right, saved, budgeted, sacrificed, now find themselves locked out or drowning in debt. Median incomes can't keep pace with costs. Savings have evaporated. Millions are trapped between rising rents and impossible mortgages. The very system designed to uplift the middle class has turned against it. The fallout reaches far beyond economics. In neighborhoods once filled with laughter, entire blocks now echo with uncertainty. Retirees are returning to work. Young couples are moving back in with parents. And renters face relentless hikes from corporate landlords who bought up homes by the thousands. In some metros, more than 1 in 5 homes is now institutionally owned, stripping away the personal connection that once defined American housing. The emotional toll is unmistakable. Home ownership once meant independence. Today, it represents vulnerability. Insurance crises in coastal states, soaring property taxes in the Midwest, and mortgage rates near 8% have turned the dream into a burden. Even those still holding on feel uneasy, as if the ground beneath them could shift again at any moment. And yet, amid the wreckage, a quiet truth emerges. The collapse was never just about real estate. It was about faith, in stability, in fairness, in opportunity. As empty houses line the streets and for rent signs replace picket fences, a generation is left wondering if the American dream was ever real, or merely a story told between recessions. The illusion is over. What remains is a country divided, between those still pretending the system works and those who have seen its cracks up close. The American dream hasn't vanished overnight. It simply priced itself out of reach.